Right now, as you watch this video, the United States government is spending $70,140. Not per year, not per month, per second. That number comes directly from the Joint Economic Committee of the U.S. Congress. Their December 2025 report shows the national debt is growing at $6.12 billion per day, $255 million per hour, $4.25 million every single minute. And it just crossed a threshold that should have every American paying attention. $38.4 trillion. Now, that's not some projection. That's not a worst-case scenario. That's the number sitting on the books right now. And here's what makes this different from every other time someone has warned about the debt. For the first time in American history, the government is now paying over $1 trillion per year just in interest. Not paying down the debt, just paying interest, just keeping the lights on. The Congressional Budget Office confirmed it. Fiscal year 2025 was the first time interest payments on the public debt crossed that $1 trillion line. And that number is only going up. Think about that for a second. 5 years ago, in 2020, interest payments were $345 billion. Today, they're approaching $1 trillion. That's nearly triple in just 5 years. And here's what nobody in Washington wants to talk about. That interest payment is now larger than the entire defense budget. The money America spends just servicing its past borrowing now exceeds what it spends protecting itself. Interest on the debt is now the second largest line item in the entire federal budget. Only Social Security costs more. Not Medicare, not defense, not education, infrastructure, and scientific research combined. Interest payments. And according to CBO projections, by 2035, that number hits $1.8 trillion annually. Now, I'm not telling you this to scare you. I'm telling you this because something very specific is happening right now in financial markets. Something that's only happened a handful of times in recorded history. The largest financial institutions in the world are repositioning. Central banks are buying gold at levels not seen since the 1960s. Foreign governments that have held American debt for decades are quietly reducing their exposure. And the smart money is making moves that only make sense if they believe the current system cannot continue. This isn't conspiracy. This isn't speculation. This is documented in Federal Reserve data, World Gold Council reports, Treasury Department filings, and the public statements of the institutions themselves. What I'm about to show you is a pattern, a four-stage sequence that has played out every single time a dominant financial system reached this exact point. And once you understand it, you'll see why Wall Street is positioning the way it is. We're going to look at the actual numbers, the verified data, the historical precedents, and most importantly, what it means for anyone holding assets denominated in US dollars. Let's start with the pattern itself. Throughout financial history, there's a sequence that repeats, not sometimes, every time. Economists have different names for it. Ray Dalio calls it the long-term debt cycle. Historians call it imperial overreach. Central bankers call it monetary regime change. But whatever you call it, the pattern has 4 distinct stages, and they always unfold in the same order. Stage 1, foundation and trust. This is where the system establishes dominance, where a currency becomes the standard, where institutions grow so large and so embedded in global commerce that questioning them seems absurd. Money flows in because everyone believes the rules are solid. The currency is backed by something real, whether that's gold, military power, or economic output. International trade settles in that currency. Other nations hold it in reserve. The system works and everyone benefits from participating. The Dutch guilder had this status in the 1600s. The British pound had it for over a century. The US dollar has had it since 1944. Stage 2, expansion through leverage. This is where the cracks begin. The system realizes it can create money faster than it creates value. Debt becomes the engine of growth. Asset prices disconnect from underlying fundamentals. Paper wealth expands while productive capacity stagnates. Everyone appears to be getting richer. Housing prices climb. Stock markets hit records. Credit flows freely, but underneath the foundation is weakening. The people running the system see the math. They know the trajectory, but the music is still playing. So they keep dancing. This stage can last decades. The warning signs are easy to dismiss because the consequences feel distant. The debt will be someone else's problem. The bill will come due later, until it doesn't. Stage 3, loss of control and repositioning. This is the phase that matters most, because this is where the insiders act. The math becomes undeniable. Interest payments consume a growing share of revenue. New borrowing goes towards servicing old borrowing. The debt compounds faster than the economy grows. Publicly, officials insist everything is fine. Confidence must be maintained. Panic must be avoided. The system depends on trust, and trust depends on the appearance of stability. But privately, something else is happening. Central banks start accumulating gold. Foreign holders begin trimming their exposure. Institutional investors shift toward hard assets. The same people defending the system in public are hedging against it in private. They're not betting on collapse. They're preparing for transition. There's a difference. Collapse is chaotic and unpredictable. Transition is manageable if you're positioned correctly. The key marker of stage 3 is the divergence between words and actions. What officials say versus what institutions do. What's reported in headlines versus what's recorded in Treasury data and central bank filings. Stage 4, reset. The system reaches a point where the debt cannot be serviced through normal means. The options narrow to 3, default, restructure, or devalue. Default is rare for reserve currency nations because they can print their own money. Restructuring requires political consensus that rarely exists, so the path of least resistance is devaluation. Print more currency, inflate away the obligations, transfer wealth from savers to debtors, reset the board. This isn't theoretical, it's documented history. The British pound lost 30% of its value overnight when Britain abandoned the gold standard in 1931. The transition from sterling to dollar dominance took less than 2 decades. The question isn't whether this pattern is real. The historical record is clear. The question is where we are in the sequence right now, and here's what the data shows. The United States completed stage 1 between 1944 and roughly 2000. The Bretton Woods Agreement made the dollar the world's reserve currency. Even after Nixon ended gold convertibility in 1971, the dollar maintained its dominance through economic and military power. Stage 2 ran from approximately 2000 to 2020. Federal Reserve assets went from $500 billion to $9 trillion. National debt went from $5 trillion to $27 trillion. Asset prices soared while median wages stagnated. The expansion was funded by leverage, not productivity. And now, the debt is $38.4 trillion. Interest payments just crossed $1 trillion annually. Central banks are buying gold at the highest rate in 60 years. Foreign holders of Treasury securities are diversifying away from dollar assets. The indicators suggest we've entered stage 3, not stage 4. The system hasn't collapsed. The dollar is still the dominant reserve currency. Treasury auctions still find buyers. But the repositioning has begun. And once you know what to look for, you can see it everywhere. Before I show you the current data, I want to prove this pattern is real, not with theory, with history. Let me show you exactly how this played out twice before. First with the British pound, then with Japan, because what happened to them is not ancient history, it's a roadmap. In 1900, the British pound sterling controlled 62% of global currency reserves. Today, it holds less than 5%. That collapse didn't happen because Britain lost a war. It didn't happen because of a single catastrophic event. It happened because of a pattern, the same 4-stage pattern I just described. And here's what most people get wrong about this history. The conventional story says the dollar replaced the pound after World War II. That Bretton Woods in 1944 marked the official handover. That sterling's dominance ended with the British Empire. That story is wrong. Research published by the National Bureau of Economic Research, conducted by economists Barry Eichengreen and Mark Flandreau, analyzed the actual composition of central bank reserves in the 1920s and 1930s. What they found contradicts everything we thought we knew. The dollar first overtook sterling as the leading reserve currency in the mid-1920s. Not the 1940s, the mid-1920s. 20 years before Bretton Woods, the transition was already underway. The shift happened gradually, then suddenly, and almost nobody at the time recognized it for what it was. Let me walk you through how it happened. Stage 1 for Britain ran roughly from the 1820s through the early 1900s. The pound was anchored to gold. The Bank of England was the world's central bank in all but name. International trade settled in sterling. London was the financial capital of the world. The sun never set on the British Empire, and the pound was the currency that made that empire function. Every major nation held sterling reserves. The system worked. Trust was absolute. Stage 2 began with World War I. Britain spent roughly 35% of its GDP fighting that war. They borrowed massively to finance it. And when the war ended, they made a decision that would ultimately destroy the pound's dominance. In 1925, Britain returned to the gold standard at the pre-war exchange rate. This sounds technical, but here's what it meant in practice. They pretended the war debt didn't exist. They acted as if each pound was still worth the same amount of gold it was worth in 1914, despite having printed enormous quantities of currency to fund the war. It was a lie backed by policy. Classic debasement disguised as stability. By the late 1920s, British debt had exploded to over 180% of GDP. They were borrowing to pay interest on previous borrowing. The math was already broken. But the facade held because confidence held. Sound familiar? Stage 3 arrived in the early 1930s. The Great Depression exposed what the numbers had been saying for years. Britain couldn't maintain the fiction any longer. Gold was flowing out of the country. The Bank of England's reserves were depleting. And here's the part that matters for understanding today. The British financial establishment knew what was coming. Internal Bank of England documents from that period show directors diversifying their personal holdings. Wealthy families began transferring assets to New York. Gold shipments from London to American vaults increased dramatically throughout 1930 and 1931. The insiders were repositioning. They were moving their wealth to safety while publicly defending the system they privately knew was failing. September 1931. Stage 4. Britain abandoned the gold standard on a Sunday evening. The announcement came without warning. By Monday morning, the pound had crashed 25%. Within weeks, it lost 40% of its value against the dollar. Countries that had trusted sterling for generations watched their reserves evaporate overnight. The Commonwealth financial system, built over centuries, collapsed in months. And here's the detail that should concern every American watching this. The transition from pound to dollar didn't take a century. It didn't take 50 years. According to that NBER research, the dollar had already achieved parity with sterling by the mid-1920s. The 1931 crisis simply made visible what the data had been showing for years. From first sign of trouble to complete loss of reserve currency status took roughly 15 years. 15 years. Today, the dollar's share of global reserves has fallen from 72% in 2001 to 58% in 2024. That's a 14 percentage point decline in 23 years. The Federal Reserve's own 2025 report on the international role of the dollar confirms these numbers. The decline is gradual, just like sterling's was. The pound didn't collapse because Britain became weak. Britain was still a major economy in 1931. It still had a powerful military. It still had global trade relationships. The pound collapsed because the debt math stopped working, because the promises exceeded the capacity to deliver, because the insiders saw it coming and positioned accordingly, while the public was told to trust the system. And there's one more lesson from the British example that applies directly to what's happening now. After 1931, the pound never recovered its position. Britain remained an important economy, sterling remained a traded currency, but the dominance was gone, permanently. Reserve currency status, once lost, does not return. The British learned this. The question is whether Americans will learn it before it's too late. But Britain was dealing with war debt and an outdated gold standard. Maybe that's not relevant to modern economies with sophisticated central banks and advanced monetary tools. So let me show you a more recent example. A country with technology, with modern financial systems, with everything we're told prevents this pattern from repeating. Japan, 1989. Tokyo, 1989. Japanese banks were the largest in the world. The Nikkei stock index had quadrupled in 5 years. Real estate in Tokyo's Ginza district sold for $250,000 per square meter. The Imperial Palace grounds were theoretically worth more than all the real estate in California combined. Economists projected Japan would overtake America by 2000. Japanese companies were buying Rockefeller Center, Columbia Pictures, Pebble Beach. The Japanese miracle was real, everyone agreed. Stage 1 complete, total confidence, unlimited money flowing in. Then the Bank of Japan flooded the system with cheap credit. Interest rates dropped to historic lows. Corporations borrowed trillions of yen to buy assets. Stock prices tripled. Real estate quintupled. The entire economy was leveraged on assets with no fundamental value justification. Stage 2, terminal velocity. Here's what happened next. In late 1989, Japan's largest financial institutions began quietly selling domestic assets. No announcements, no press releases. Internal research from major Japanese brokerages shows executives reducing personal exposure to Japanese equities while recommending clients buy more. Stage 3, repositioning. January 1990. The Nikkei crashed. It lost 60% in 18 months. Real estate collapsed 70% over the following decade. Japan entered an economic stagnation they still haven't fully escaped. 35 years later, Japanese stocks only recently returned to 1989 levels. An entire generation lost their savings, their retirements, their futures. Stage 4 delivered exactly as the pattern predicted. And here's why this matters for Americans today. Japan had technology. Japan had sophisticated monetary policy. Japan had modern financial markets. None of it mattered when the debt math broke. The Bank of Japan tried everything. Zero interest rates, quantitative easing, massive fiscal stimulus. They invented the playbook the Federal Reserve now uses. It didn't work. The bubble couldn't be reflated. The losses couldn't be erased. The consequences couldn't be avoided. 3 examples now. Dutch tulips, British sterling, Japanese assets, 3 different centuries, 3 different economies, 3 different technologies. Identical pattern, identical outcome. Now let me show you why the current American data fits this pattern exactly. Let's look at where America stands right now, not projections, not estimates. Verified government data. Total national debt as of December 2025, $38.4 trillion. 1 year ago, it was $36.17 trillion. That's $23 trillion added in 12 months. The Joint Economic Committee calculates that's $6,560 per person, $16,475 per household in 1 year. The debt crossed $37 trillion in mid-August 2025. It hit $38 trillion by late October. 2 months, $1 trillion. Now here's the number that changes everything. Interest payments on that debt, $981 billion in the 12 months, ending October 2025. The Congressional Budget Office confirms that gross interest payments crossed $1 trillion for the first time in fiscal year 2025. 5 years ago, interest was $345 billion and nearly tripled. And it's accelerating. CBO projections show interest hitting $1.5 trillion by 2032, $1.8 trillion by 2035. Those aren't worst-case scenarios. Those assume nothing goes wrong. Here's what that means in practical terms. Interest on the debt is now the second largest federal expenditure. Only Social Security costs more. Interest payments now exceed the entire defense budget. They exceed all spending on education, infrastructure, transportation, and scientific research combined. The government now pays more to service past borrowing than to invest in the future. Debt to GDP ratio, 122.6% as of the end of fiscal year 2025, according to CBO's September outlook. That's the highest since World War II. But in 1946, the debt was falling. Today, it's rising. And here's the math problem nobody in Washington will address. The debt grows by roughly $2 trillion per year. Real economic growth adds maybe $400–500 billion in tax revenue. You cannot grow your way out of that gap. You cannot tax your way out either. The wealthy have already repositioned their assets. That leaves one option. The same option every country in this situation eventually chooses. Devalue the currency. But before that happens, something else occurs first. The smart money moves. Central banks reposition. Foreign holders reduce exposure. That's not theoretical. It's happening right now. While politicians debate and markets fluctuate, central banks are acting quietly, systematically. The World Gold Council tracks official gold purchases globally. Their data shows something unprecedented. In 2024, central banks bought 145 tons of gold. That's the third consecutive year above 1,000 tons. Before 2022, the annual average was 473 tons. Purchases have more than doubled. This is the 15th consecutive year of net central bank gold buying. Not a single year of net selling since 2010. Let me put that in perspective. Poland's central bank was the largest buyer in 2024, adding 90 tons. Governor Adam Glipinski publicly stated his goal: raise gold to 20% of national reserves. They've now exceeded that target at 21%. Turkey added 75 tons. India added 73 tons, more than 4 times their 2023 purchases. The Reserve Bank of India bought gold every single month of 2024. China officially added to reserves for 18 consecutive months through late 2024. And analysts believe actual Chinese purchases far exceed reported figures. Here's what these central banks understand. Gold carries no counterparty risk. It can't be frozen by sanctions. It can't be devalued by another country's central bank. It can't be printed. After Western nations froze $300 billion in Russian reserves in 2022, central banks worldwide received a clear message. Dollar assets carry political risk. The response was immediate. Gold demand from official institutions now represents over 20% of total global gold demand. In the 2010s, it averaged 11%. Gold hit $4,000 per ounce in October 2025. JP Morgan's commodity team projects $5,000 by end of 2026. Goldman Sachs has similar targets. And here's the connection to dollar reserves. The dollar's share of global foreign exchange reserves fell from 72% in 2001 to 58% in 2024. The Federal Reserve's own July 2025 report confirms this decline. Central banks aren't panicking. They're diversifying, methodically, persistently. They're not predicting collapse. They're preparing for transition. And they're not the only ones reducing dollar exposure. Japan is the largest foreign holder of U.S. Treasury securities, $1.1 trillion as of early 2025. In May 2025, Japanese Finance Minister Katsunobu Kato made a statement that sent shockwaves through financial markets. He said selling U.S. Treasuries was a card on the table in trade negotiations with America. He walked it back 2 days later, but the message was clear. The largest foreign creditor publicly acknowledged using American debt as leverage. That's not supposed to happen. JP Morgan data shows Japanese investors sold approximately $41 billion in long-dated treasuries between January and April 2025. The selling accelerated after trade tensions increased. China holds $784 billion in treasuries, down from its peak above $1.2 trillion. In December 2024 alone, China sold $9.6 billion. The UK sold $44.1 billion that same month. Here's the broader picture. Foreign holdings of U.S. debt totaled $8.5 trillion at the end of 2024. That sounds massive, but total publicly held debt is $28.1 trillion. Foreigners now hold just 30% of American public debt, down from higher levels a decade ago. The share is shrinking because debt is growing faster than foreign appetite to buy it. And the buyers who remain are demanding higher yields. J.P. Morgan analysts note that foreign investors now require a higher risk premium for U.S. debt given persistent fiscal concerns. Translation, they want to be paid more to take the risk. This is stage 3 behavior. Foreign creditors aren't dumping everything overnight. That would crash their own holdings. Instead, they're gradually reducing exposure, diversifying into gold, demanding better terms. The same pattern that preceded sterling's collapse, the same pattern that preceded Japan's crash. And now major Wall Street institutions are positioning accordingly. Pay attention to what major financial institutions are doing, not what they're saying to retail investors, what they're actually doing. Goldman Sachs Asset Management, January 2026. Outlook. USD likely has further to fall as a less exceptional macro backdrop erodes a still rich valuation. That's Goldman telling institutional clients the dollar is overvalued and headed lower. Morgan Stanley's Q1 2026 Global Allocation Guide lists U.S. Treasuries as underweight. Their reasoning, potential growth reacceleration in 2026 means fewer Fed cuts than markets expect. Translation, Treasury prices may fall further. J.P. Morgan's mid-year 2025 outlook included a striking number. Their economists assigned a 40% probability to recession, not a fringe prediction. 4 in 10 odds from one of the world's largest banks. Now, look at where they're directing capital. Gold. Every major institution has raised price targets. J.P. Morgan projects $5,000 per ounce by end of 2026, potentially $5,400 by 2027. Goldman Sachs targets $5,000. UBS set $3,800 for 2025, already exceeded. Standard Chartered raised their target to $4,500. These aren't gold bugs or doomsayers. These are the largest financial institutions on earth telling clients to increase precious metals exposure. Goldman's research explicitly cites deficit concerns and dollar weakness as drivers. Meanwhile, their Q4 2025 data shows diversified portfolios outperformed U.S.-focused portfolios for the first time since 2017. International equities beat American equities. The U.S. exceptionalism trade is fading. Here's what this means. The institutions managing trillions of dollars are shifting allocation away from dollar assets toward gold, toward international markets, toward inflation protection. They're not predicting apocalypse. They're pricing in transition. And they're positioning their largest clients accordingly. The question is whether retail investors are paying attention. At this point, 3 objections always come up. Let me address them directly. Objection 1, this time is different. It's not. Every generation believes their situation is unique. The Dutch thought new tulip cultivation techniques made prices permanently higher. The British thought their empire made sterling untouchable. The Japanese thought cultural superiority and technological dominance made their economy special. Americans think military power and reserve currency status make the dollar immune. The math doesn't care about narratives. Debt that compounds faster than growth eventually breaks. It broke for the Dutch. It broke for the British. It broke for the Japanese. The mechanism is identical every time. Objection 2, technology will save us. Technology is deflationary. It makes goods cheaper. That's wonderful for consumers. It's terrible for paying fixed amount debt. Your mortgage doesn't shrink because smartphones got better. Government debt doesn't shrink because AI increased productivity. Debt is denominated in currency. You owe specific dollars regardless of technological progress. Japan had the most advanced robotics and electronics industry in 1989. It didn't prevent their collapse. Technology changes what we produce. It doesn't change debt mathematics. Objection 3. The dollar is too dominant to fail. The British pound was more dominant in 1900 than the dollar is today. Sterling controlled 62% of global reserves. The British Empire spanned the globe. London was the unquestioned financial capital of the world. Dominance doesn't prevent decline. It just means further to fall. The dollar won't collapse overnight. Sterling didn't either. But reserve currency status, once lost, doesn't return. Britain learned this. The pound still exists. It's just no longer the foundation of global finance. The pattern doesn't require belief. It only requires math. Let me be clear about what I'm not saying. I'm not predicting the dollar will collapse tomorrow. I'm not telling you to sell everything and buy gold. I'm not a financial advisor, and this isn't financial advice. What I am saying is this. A pattern exists. It's documented across centuries, and the current data fits that pattern. The U.S. debt is $38.4 trillion and growing $6 billion daily. Interest payments crossed $1 trillion for the first time. Central banks are accumulating gold at the highest rate in 60 years. Foreign holders are reducing Treasury exposure. Major institutions are shifting allocation away from dollar assets. These are facts, exposed in government data, Federal Reserve reports, and institutional research. The insiders are repositioning. That's not speculation, it's observable. What you do with this information is your decision, but consider this. The Dutch, who sold tulips before February 1637, preserved their wealth. Those who held lost everything. The British families who moved assets to New York before September 1931 protected their futures. Those who trusted official assurances did not. The Japanese executives who quietly reduced exposure before January 1990 survived the crash. A generation of ordinary investors didn't. The pattern rewards those who see it early. It punishes those who wait for official confirmation. By the time authorities admit the problem, the repositioning window has closed. I don't know when stage 4 arrives. Nobody does. But the indicators suggest stage 3 is underway. The question isn't whether you believe me. The question is whether you'll watch the data yourself. Verify the numbers. Study the history. Make your own assessment. Because what happens next is up to you. If this video helped you understand what's happening, subscribe for more analysis. Share it with someone who needs to see these numbers. And let me know in the comments. Do you think the pattern applies today?